Over 40% of Canadian seniors may be paying more tax than they need to, and many don't even realize it. Every year, thousands of retirees lose part of their hard-earned income because of small rule changes buried deep inside tax updates. No bold headlines, no urgent warnings, just quiet adjustments that can slowly chip away at your retirement savings. And this year, there's one rule in particular that's catching people completely off guard. Here's the scary part. It doesn't take a huge mistake to trigger it. A slightly larger withdrawal from your retirement account, a small increase in pension income, even a simple filing oversight could mean unexpected taxes, benefit reductions, or even an OAS clawback. Imagine opening a notice and discovering you owe money you never planned for. For seniors living on a fixed income, and that's not just inconvenient, it's stressful. So what is this new rule? Who does it affect? And how can you protect yourself before it's too late? Let's break it down. Number 1, it can quietly increase your taxable income overnight. Here's what most seniors don't realize. A small change in how certain retirement income is reported or calculated can push you into a higher taxable income bracket without you feeling richer at all. That's the dangerous part. You may not have earned more money in a meaningful way, but on paper your income suddenly looks bigger. And when that happens, the tax system reacts automatically. For example, a slightly larger RRIF withdrawal, an increase in CPP, or even investment income that performed better than expected can stack together. Separately, each one seems harmless, but combined, they can push you over key thresholds that determine how much tax you owe. In some cases, this also affects income-tested benefits like OAS, meaning you could face partial clawbacks simply because your reported income crossed a line by a few $100s. What makes this especially frustrating is that many seniors only discover the impact months later, when they receive a tax notice or see that their benefits have been adjusted. By then, the money is already gone. So what can you do? First, review your total projected income before the year ends, not just one source. Look at your pension, government benefits, RRIF withdrawals, and investment income together. Second, consider spreading withdrawals across multiple years instead of taking larger lump sums. And finally, if you're unsure, use a simple tax calculator or speak with a financial professional to estimate where your income stands. A few proactive steps today can protect thousands of dollars tomorrow. Why, if this opened your eyes even a little, drop a comment below saying, "I'm checking my income," so we know you're taking action. We put serious effort into researching and simplifying these updates for you. So please subscribe to the channel. It's just one click, but it helps us keep protecting your retirement. Number 2, it could trigger an unexpected OAS clawback. This is where things become truly frustrating. Many seniors believe that once they qualify for old age security, that money is guaranteed. But what most people don't realize is that OAS is tied directly to your net income. And if that income crosses a certain threshold, the government can start taking it back. This is known as the OAS clawback, and it can happen faster than you think. Here's how it works in simple terms. If your annual income rises above the government's set limit, you must repay part of your OAS benefits. The shocking part? It's not just large jumps in income that cause this. Even a moderate RRIF withdrawal, capital gains from selling investments, or extra rental income can push you over the line. And once you cross that threshold, either every additional dollar can reduce your benefit. Imagine carefully budgeting your retirement around a fixed monthly OAS payment, only to receive a notice saying part of it must be repaid. For many seniors, that's hundreds or even thousands of dollars gone unexpectedly. So what can you do? Start by knowing the current income threshold for OAS recovery. Plan withdrawals strategically to avoid sudden spikes in income. If possible, spread taxable income across multiple years. And if you're married, explore income splitting strategies to balance earnings between spouses. The key lesson here is simple. Your OAS isn't automatically safe. With careful planning, you can protect it. But ignoring this rule could cost you significantly. If you've ever worried about losing part of your benefits, comment "Protect my OAS" below so we know this matters to you. We spend hours researching these changes to keep you informed. So please subscribe to the channel. It's just one click, but it helps us continue fighting for your financial security. Number 3, it can force larger RRIF withdrawals than you expected. Many seniors assume they can control exactly how much they withdraw from their retirement savings each year. But here's the catch. Once your RRSP converts to a RRIF, the government sets a mandatory minimum withdrawal amount, and that percentage increases as you age. That means whether you need the money or not, you're required to take out a certain amount every year. Now here's where this becomes a problem. Those required withdrawals count as taxable income. So even if you would prefer to leave that money invested, growing quietly in the background, you may be forced to withdraw more than you planned and pay tax on it. As the years go on and the required percentage rises, those withdrawals can become significantly larger. For some seniors, this creates a ripple effect. And a higher RRIF withdrawal can push your total income into a higher tax bracket. It can also impact income-tested benefits like OAS or GIS. What felt like your own savings suddenly triggers tax consequences you didn't fully anticipate. Picture this. You carefully structured your retirement income to stay under certain limits. Then your RRIF minimum increases, and without changing anything else, your total reported income jumps. It's subtle, but powerful. So what can you do? Consider withdrawing strategically in the early retirement years, before mandatory minimums become larger. Some retirees even choose to withdraw slightly more in lower income years to reduce future pressure. The key is planning ahead instead of reacting later. Because once those mandatory withdrawals rise, the tax bill often rises with them. If RRIF rules have ever confused you, comment RRIF Planning Matters below. We put serious time into breaking these rules down clearly for you. So please subscribe to the channel. It's one simple click, but it helps us keep delivering valuable updates like this. Number 4, it can reduce your GIS benefits without warning. If you're receiving the Guaranteed Income Supplement, GIS, this is especially important. GIS is designed to support low-income seniors, but what many people don't fully understand is how sensitive it is to income changes. Even small increases in reported income can reduce your monthly GIS payment, sometimes more than expected. Here's the tricky part. GIS calculations are based on your previous year's income. That means a decision you made last year, like withdrawing extra funds from your RRIF, selling investments, or earning part-time income, could affect the benefits you receive this year. And because it's calculated behind the scenes, the reduction can feel sudden and confusing. Imagine relying on a certain monthly amount to cover groceries, utilities, or medication. And then one month, that payment drops. No warning, no dramatic announcement, just less money deposited into your account. For seniors on tight budgets, that change can be stressful and disruptive. What makes this rule even more frustrating is that not all income is treated the same way. Some types of income may affect GIS more than others. That's why planning withdrawals and understanding what counts toward your net income is so important. So what can you do? First, keep track of any additional income you plan to take. Second, before making large withdrawals, consider how they might impact next year's GIS. And third, if your income has dropped significantly, you may be able to request a reassessment sooner rather than waiting a full year. A little foresight today can help protect the benefits you depend on tomorrow. If you or someone you know receives GIS, comment GIS awareness below so others see this too. We work hard to simplify these complicated rules, so please subscribe to the channel. It's just one click, but it helps us continue supporting seniors like you. Number 5, it can impact survivor benefits more than you think. Here's something many couples don't talk about. What happens to income and benefits when one spouse passes away? It's an emotional topic, but it's also a financial reality. And under this new tax rule, the impact on a surviving spouse can be much greater than expected. When two people are alive, income can often be balanced between them. There may be opportunities for pension income splitting, shared tax brackets, and lower combined tax pressure. But when one spouse passes away, that structure changes instantly. The surviving spouse may suddenly receive most, or all, of the household income in their own name, and that can push them into a higher tax bracket almost overnight. Here's the painful part. While household expenses might not decrease by half, tax benefits often do. Certain credits are lost, income thresholds shift, and government benefits tied to income may be recalculated based on a single return instead of two. This can lead to reduced OAS, adjusted GIS payments, or higher overall taxes. Many seniors assume survivor benefits will simply continue, but the tax implications behind the scenes can significantly change the amount that actually reaches the bank account. So what can couples do now? First, review how income is structured between both spouses. Second, consider long-term planning strategies that smooth income over time. And third, have open financial discussions, even if they're uncomfortable. Preparation today can prevent financial shock later. Because when life changes, the tax system changes with it. And planning ahead makes all the difference. If you're planning ahead for your family's future, comment "Planning for Peace of Mind" below. We put real effort into breaking down these sensitive but crucial topics, so please subscribe to the channel. It's one simple click, but it helps us keep protecting families like yours. Number 6, small filing errors can now cost you much more. Here's something that surprises many seniors. It's not always big financial decisions that create problems. Sometimes it's small filing mistakes. And under updated enforcement practices, even minor reporting errors can lead to reassessments, benefit adjustments, or unexpected repayment notices. Think about it. A missed slip, a forgotten T5 for investment income, a simple typo in reporting pension income. These things happen. But when your total income is used to calculate taxes, OAS recovery, or GIS eligibility, even a small discrepancy can trigger automatic recalculations. The frustrating part is that many seniors don't realize there's an issue until months later. You might receive a letter saying your return has been reassessed. Suddenly, you owe additional tax. Or your future benefit payments are adjusted to recover an overpayment. It can feel confusing, even intimidating. And because so much of the system is automated today, mismatches are detected more quickly. Financial institutions report income directly. Government systems cross-reference data. That means errors that may have slipped through years ago are now more likely to be flagged. So what can you do? First, double-check every tax slip before filing. Make sure all income sources are included. Second, keep copies of documents in case questions arise later. And third, if you receive a notice, don't panic. Review it carefully and seek clarification if needed. Being proactive doesn't just protect your money, it protects your peace of mind. A few extra minutes reviewing your return can save months of stress later. If you always double-check your tax return, comment "I review before I file" below. We spend hours researching these changes to keep you informed, so please subscribe to the channel. It's just one click, but it helps us continue creating videos that protect your retirement. Number 7, timing your withdrawals. Now matters more than ever. Here's something many retirees overlook. When you withdraw, your money can be just as important as how much you withdraw. Under updated tax thresholds and benefit calculations, timing has become a powerful and sometimes dangerous factor in retirement planning. Let's say you decide to take a larger withdrawal this year to fund a home repair, help a grandchild, or simply enjoy a well-deserved vacation. On the surface, that makes perfect sense. It's your money. But that one larger withdrawal could push your annual income higher than usual. And because government benefits and tax brackets are calculated annually, that single spike can have ripple effects. A higher income year could mean paying more tax, triggering partial OAS recovery, or reducing next year's income-tested benefits. Meanwhile, the following year might show lower income, but by then, the impact has already happened. This is why spreading withdrawals across multiple years can sometimes be smarter than taking one large lump sum. By smoothing your income, you may stay under key thresholds and maintain more predictable benefit levels. Another strategy some retirees consider is withdrawing slightly more in lower income years, before mandatory minimums increase, to reduce future tax pressure. The goal isn't to avoid taxes entirely, it's to manage them wisely and prevent unpleasant surprises. Retirement isn't just about saving money anymore. It's about strategic timing. A little planning around the calendar can make a noticeable difference in what you keep. If you've ever taken a large withdrawal and felt the tax impact later, comment "Timing is everything" below. We truly put heart and effort into simplifying these complex rules for you, so please subscribe. Number 8. Inflation adjustments are changing the game quietly. Here's something that sounds harmless but can have a big impact. Inflation adjustments. Every year, the government adjusts tax brackets and benefit thresholds to reflect rising living costs. That sounds like good news, and sometimes it is. But here's the twist. Those adjustments don't always protect you the way you think. If your income rises faster than the inflation adjustment, even slightly, you could still move into a higher effective tax range. For example, CPP payments may increase. Investment income might grow. RRIF minimum withdrawals certainly rise as you age. If those increases outpace the adjusted thresholds, your taxable income climbs faster than the system's protection. And here's the subtle danger. Many seniors assume that because thresholds are indexed to inflation, they're automatically safe. But index does not mean immune. A modest bump in income can still reduce benefits or increase your tax payable, especially when multiple income sources are combined. Picture it like this. The goalposts are moving, but so is your income. And sometimes your income moves just a little faster. That's why it's important not to rely on assumptions. Review updated thresholds each year. Compare them to your projected income. Even small differences can matter when it comes to OAS recovery or GIS eligibility. Inflation adjustments may sound technical and distant, but in reality, they directly influence how much of your retirement income stays in your pocket. Quiet changes can have real consequences. So if you didn't realize inflation adjustments could affect you this way, comment "Staying informed" below. We dedicate serious time to breaking down these hidden details, so please subscribe to the channel. It's just one click, but it helps us continue bringing clarity to complicated topics. Number 9. It could affect how your investments are taxed. Many seniors focus on pensions and government benefits, but overlook how their investments fit into the bigger picture. And this is where the new tax dynamics can quietly create surprises. Interest income, dividends, and capital gains are all treated differently under the tax system. But here's what matters most. They all increase your net income. That means even if your investments are performing well, which should be good news, they could push your total reported income higher than expected. For example, selling an investment property or cashing in stocks that have grown significantly can trigger a capital gain. Only a portion of that gain is taxable, but it still counts toward your overall income. That single transaction could push you into a higher tax bracket or trigger an OAS recovery. Dividend income can also be tricky. Because of the dividend gross-up mechanism, the amount added to your taxable income may appear higher than the cash you actually received. On paper, your income looks inflated, even though your bank account tells a different story. The key here is awareness. Before selling major assets or restructuring investments, consider the timing. Spreading sales over multiple years may reduce tax impact, and understanding how different types of income are calculated can help you avoid unpleasant surprises. Investments are meant to strengthen your retirement, not complicate it. But without careful planning, success in the market can unexpectedly affect your taxes and benefits. Not as sure if investments have ever surprised you at tax time, comment "Smart investing matters" below. We put real time and effort into simplifying these important financial shifts, so please subscribe to the channel. It's just one click, but it helps us continue sharing valuable insights with you. Number 10. Most seniors simply haven't been told about it. And here's perhaps the most important reason of all. Awareness is low. Many seniors are responsible, organized, and careful with their money. They file taxes every year. They track their benefits. They assume that if something major changes, someone will clearly explain it. But that's not always how the system works. Tax updates and income threshold changes are often announced quietly, buried in technical documents or government updates that most people never read. Financial institutions may send general notices, but they rarely break down how the changes apply to your specific situation. As a result, thousands of seniors continue making normal financial decisions without realizing the ripple effects those decisions could now have. The truth is, no one calls to warn you before your income crosses a clawback line. No alert pops up saying, "Be careful. This withdrawal could reduce next year's benefits. The system simply calculates, adjusts, and sends a notice later. And by that time, the opportunity to plan differently has already passed. This isn't about fear, it's about empowerment. When you understand how income thresholds, withdrawals, and benefit calculations interact, you regain control. You can plan strategically. You can ask better questions. You can avoid unnecessary losses. Staying informed today protects your retirement tomorrow. Because in retirement, knowledge isn't just power, it's income protection. If this is the first time you're hearing about these risks, comment "Knowledge protects me" below so we know this video made a difference. May we truly invest time and research into simplifying these complex topics for you. So please subscribe to the channel. It's just one click, but it helps us continue protecting seniors like you. Retirement should feel stable, predictable, secure. But as we've seen today, even small adjustments in tax rules, income thresholds, or withdrawal requirements can quietly affect how much money actually stays in your pocket. And the most surprising part? Many of these impacts don't come from dramatic mistakes. They come from normal financial decisions that simply weren't planned with updated rules in mind. A slightly larger RRIF withdrawal, selling an investment at the wrong time, a modest increase in pension income. On their own, these don't seem alarming, but when combined with income-tested benefits like OAS or GIS in shifting tax brackets, they can create a ripple effect that reduces what you receive or increases what you owe. The key message here isn't fear, it's awareness and preparation. When you understand how your total income works together, pensions, government benefits, investments, and withdrawals, you gain control. You can smooth income across years. You can avoid unnecessary clawbacks. You can reduce surprises at tax time. And most importantly, you can protect the retirement income you worked so hard to build. Remember, the system doesn't warn you before changes affect you. It simply calculates and adjusts. That's why staying informed is so powerful. Your retirement savings represent decades of effort, discipline, and sacrifice. A little proactive planning today can help ensure that more of that money stays where it belongs. With you, stay informed, stay strategic, and most importantly, stay in control of your financial future.